Welcome to the latest of our conversations with Michael Hughes, who is economic and investment consultant to the Fiducia range of portfolios. Michael, can I begin by saying what we obviously want to do is to review what's happened in 2016. In many ways, that was an extraordinary year. The Brexit result in June, which was certainly a surprise. Change of government since then, and to the economy, or certainly to the economic prospects and the policy of in terms of the policy that the government is pursuing. And then President Trump's election. Again, new government, new style of government, new economic approach. So how's that all affected markets and especially our portfolios during that period? I've actually had a look at the portfolio performance, and it's quite interesting that all of the portfolios performed especially well. Even the low risk portfolios, but certainly the higher risk portfolios did particularly well. So I suppose, given an extraordinary year, are those the results that we should have expected? And a question of digging into the reasons that lie behind.
Well, as you say, John, it was an exceptional year, and actually quite a challenging year for investment managers, because many of the fears that people had weren't actually realised. If you think back to this time last year, in February of 2016, the markets had started very weak indeed, because there was a concern that China was going to implode. Well, it didn't, and markets therefore recovered. And when we had the Brexit vote, sterling and UK assets were hit hard. And then obviously when we had the Trump election, you had this massive rally at the end of the year. So if you were an equity manager, you would have had to change your portfolio 3 times in 1 year, which is very challenging. And it's one of the reasons actually that the average global equity manager only delivered about half the total returns that came from the market as a whole. Because it's unrealistic to ask an investment manager to change his strategy dramatically 3 times in a year. So the figures were great, but it was a very challenging time for quite a few managers. Now, if we go into this year, to some degree, it is a different world. There will always be things you don't see coming, but there are 3 things we do know about. The first is that the era of deflation has come to an end. We're now looking at inflation and obviously having to try and guess how big a problem that's likely to be. The second is that central banks in the US and to some degree the UK are coming to the end of that quantitative easing money printing program, and that has implications for markets. And finally, there's a bigger emphasis on what's happening to fiscal policy, not least in Europe, but also perhaps in America with the new Trump administration. So put all those 3 things together, it's a different set of policies that are coming into place, and it comes at a time when the underlying momentum of economic growth has probably been better than people would have foreseen. So inevitably, that means you have to make changes to the portfolios.
In what areas will we be making those changes then?
Well, I think there are 3 decisions we have to make. The first is whether we should move away more from financial assets like bonds and to some degree equities to real assets, to property, to infrastructure, possibly to private equity. So we really have to change our policies to reflect 3 different things. The first is that we're now looking at a period of inflation, not deflation, and that means that we try to move some of our allocations away from financial assets like equities and particularly bonds, more so to real assets like property, infrastructure, private equity and indeed commodities. The second thing is that we have to make a decision about the dollar. The dollar has been a pretty strong currency for the last few years and indeed got extra strength after President Trump got into power. But it may be that people have more concerns about the policies he's putting in place, and hence if the dollar's strength isn't going to continue, that has a particular set of circumstances for emerging markets, which by and large do better if the dollar's weak, and it has implications for the UK, where sterling has fallen quite a long way against the dollar. So that's a decision we have to make. And the third thing is that we have some pretty important elections coming in Europe this year, and the whole Eurozone project is carrying a whole series of risks which are more appropriate to focus on this year than previous years because of those elections and because of the uncertainty that surrounds them. So putting all those things together, I think we are starting to adjust our portfolios to reflect the things we know about, and obviously we have to deal with the things we don't know about when and if they materialise.
I mean, you said before that the issue in Europe is when the next sort of, if not a crisis, but the next slowdown happens, because the southern countries are still, very much on the edge. And recent reports are suggesting, obviously, Greece and Italy are sort of, perhaps sliding, further backwards. So do you see this leading to any sort of significant change in terms of, what's happening in as far as the euro and Europe generally is concerned?
Well, I don't think it's actually unique to Europe. We've had a fairly prolonged and extended economic recovery, really going back to 2009. So we're looking at 8 years, which is pretty lengthy. It's been a very subdued recovery, but otherwise. So if anything, we're nearer to the end of an economic cycle than we are at the beginning, globally. And hence, if we look into 2018, we may be getting more concerned about economic growth not giving positive surprises, and that will be perhaps even more sensitive to those southern European states, but it won't be unique to them if you have a slowdown in economic growth. Part of that might be triggered by interest rates having to rise and obviously activity slowing down. Part of it might be the response to protectionism coming out of the States, but my suspicion is that most of it will come from a squeeze on companies and company profits that actually make them even more reluctant to invest and to sustain economic growth for a year or two after that.
So in essence, we're looking at a further period of lower than historically average rates of growth as far as the global economy is concerned?
Well, I think the trend rates of growth clearly are much lower than they have been in the last 20, 30 years, partly because of demographics, partly because of technological changes, and that doesn't turn around quickly. But in the last year or so, we've actually seen more positive surprises to economic growth. In the year ahead, I suspect we will end up having more negative surprises, and possibly more negative surprises on inflation, particularly in the UK. And I focus on the UK in this because I think that the UK probably has now made a mistake with its monetary policies. Remember, the whole point of quantitative easing was to provide a stimulus to economies when the banks were having to contract their balance sheets and to get their risks back under control. They've done that in the States, which is why quantitative easing is ending, but they've also done it in the UK. But quantitative easing has been maintained. So if anything, I think the UK has been overstimulated, and hence the recovery that we've seen and the surprises we've seen post the Brexit vote perhaps shouldn't be surprising, because actually we were giving more stimulus than we should have done. And that, I think, might have repercussions to our inflation rate through the next year or two. So I'm particularly sensitive about what may happen to inflation in the UK.
So we may see some catch-up in interest rates during
I think
this
it's
year.
more likely that interest rates will rise by more in the UK than they will in the US this year.
Okay. But in general terms, as far as the portfolios are concerned, a degree of sort of risk control or further risk control, but otherwise no great change in terms of our asset allocations and our approach?
No, we have already started to make changes to the allocation away from financial assets and towards real assets. I suspect we might have to be more sensitive to the inflation risks, and that has implications for what we invest in. But if anything, we took reasonable levels of risk last year, whereas if anything, we'd be looking to take a bit of risk away this year. And particularly if you think economic growth is going to slow down in 2018, there will come a time when we have to do that. We're making this interview in February. The last 86 days, we have not had any single day of major correction in the US stock market. And the last time this happened was in 2006, before the peak in 2007. So I think we should be warned that actually, though it's been a series of positive surprises, life doesn't continue like that. And we may need to have some sort of retreat from what seems to be too good a time.
It'll be very interesting to catch up again in approximately 6 months' time and see what's happened then during
Thank you.
2017. Thank you very much indeed.